in the Johannesburg studio is the CEO of Aveng, and that is Roger Jardine. Before we talk to Roger, though, let me give you some of the highlights of these interim numbers released earlier today. Revenue up 30% to 25 billion, operating profit up 56% to 518 million rand. Headline earnings 43% higher, headline earnings per share up 48%. But the two-year order book just around about 40 billion, which is a fall of 15%. Let's talk to the CEO now. Roger, thanks very much for popping in. Generally, how's the construction business? Are things stabilising?
Well, good, thank you. I don't think we're out of the woods yet. Certainly, much of our growth has been outside of South Africa, and a lot turns on the infrastructure rollout here in South Africa. In that 40 billion order book, about 7.5% or so is South African public sector. And then again, the whole backdrop of the global economic situation. So these numbers have been boosted by strong operational performance from all of our divisions. I think our steel businesses reflect the soft conditions in that market. But certainly, I don't think we're where we should be.
You have said the word difficult in your post-results press release, the commentary. This is something we hear all the time from CEOs. Good numbers coming out, but challenging conditions, difficult conditions. And you also say, which is interesting, projects are taking longer to conclude. Why is that? Is that an internal Aveng problem, or is that a problem of the country, infrastructure strikes, etc.?
Well, I think again at the macro level, companies in these times are holding back a bit. Being more circumspect before allocating huge capex to projects. So that's really what we mean when we say it's taking a bit longer. Our order book to December was down, but then January and February we won some big awards, which pushed it up again. So a lot is about timing.
You also mentioned energy, and energy is, of course, something that South Africa is going to be investing in for decades to come, I think. How important is the energy or the potential energy rollout by the government important to Aveng?
Yeah, look, I think the government has published the Integrated Resource Plan, which sets out a vision for basically our energy growth trajectory. There's talk of nuclear. We've certainly ramped up in terms of our nuclear team. We are participating in the government's renewable energy program. So energy, not only for South Africa, but in the other markets that we operate in, is a very huge driver of growth going into the future. And so we're positioning for that.
We're going to have a look at the operational side of things in a moment. Roger, you can go through each of your operations. You've mentioned that most of them are firing quite nicely. What about margins, though? We keep on hearing about margins, some jobs actually being turned down and other jobs, the margins way below the average of the last decade or so. What has been your experience over 6 months?
Yeah, definitely, given the difficult trading conditions, margin pressures are there. Let me start with our Australian operations, where margins are at 1.5%. We've always said that our target margin is between 4 and 5%. Now, one of the reasons for that suppressed margin is the fact that we have reported on some very difficult projects that we are delivering in Australia. We've taken provisions for that. If you add those issues back to that margin, we're within our target range. Closer to home in South Africa, our target margin is also 4 to 5%. And our South African construction business, were it not for labour strikes and industrial action, that business would have broken even or even made a small profit. So macro issues affecting margins, and then closer to home, the labour situation, which has to be resolved sooner rather than later. I think South Africa cannot afford.
Do you think the labour situation? Do you think the labour situation from Aveng's point of view is behind you now and you've managed it well and you don't think anything's going to flare up again? Or do you think that's an ongoing issue that you keep your eye on?
Yeah, look, these numbers, we were affected in terms of our operating profit, about 23%, about 120 million rand negative effect through strikes and industrial action in these numbers. That's a huge number. It's not behind us. I think we make a lot of effort with our own workers and our staff. But against that backdrop, there's a whole macro labour environment that affects that as well. For example, in January and February, Medupi, where we're working in joint venture, has been heavily affected. That we'll see in the second 6 months. And I've actually cautioned the market that the outlook for the 6 months will be influenced by the degree to which the labour situation stabilises.
We will have a look at your outlook statement in a couple of minutes' time if we can, Roger, but let's have a look at the operational side of things now. I know that the Grinica division is still losing money, but not quite as bad, but maybe you could go through the highlights and the lowlights of the interim period.
Yeah, looking specifically at Aveng Grinica LTA, that business, you'll recall in last year we reported a loss of close to 750 million rand. Operationally, it's done a lot better, but still not in a profit-making position. We have, however, started to roll out our strategy outside of South Africa. And in fact, in the numbers we're reporting, more than 80% of our profit is outside of South Africa. Working in areas like Mozambique, in Mauritius, where we have been named the preferred bidder on a very big road decongestion project, which involves a concessions element, and also looking at West Africa. So we do expect, as the full effects of our cost cutting exercises and cost management starts to come through, and our growth strategy outside of South Africa in particular, we should see a margin uplift there. In Australia, similarly, a lot turns on us being able to get these problem contracts under control. We've resolved the Como contract. Adelaide is behind us, and now the QCLNG pipeline and Haypoint, which is on our watch list, we're making progress in dealing with those risks. And that also should return to the target margin of between 4 and 5%. So overall, a lot of internal levers being pulled. On our side, we want to control the things that we can control, and then infrastructure spend in South Africa, growth on the rest of the continent, and growth in Southeast Asia will certainly drive our growth going forward.
Yes, indeed. I mean, of course, the rollout of infrastructure from the public sector is something you can't control. What you can control, though, is your strategy towards the countries beyond South Africa's borders. When you talk about Mozambique and when you talk about Mauritius and you talk about the rest of Africa, is this deliberately targeting a diversification geographically of your business because of the slowdown in South Africa, or is this simply because jobs are presented to you or tenders are presented to you?
Well, you know, Aveng is a global company. We're currently in 30 countries, and so growing in emerging markets is core to our strategy. The weighting of South Africa in our revenue mix is not a deliberate strategy. As I'd like to say, we fish where the fish are. Last year, when we reported on our numbers, the South African private sector accounted for 3.6% of our 45 billion rand order book. Now it's at about 7.5% of the 40 billion rand order book. And it's gone up, yes, because we have won some new big projects in South Africa, but also because Australia has gone down. So we're not deliberately avoiding South Africa. This is our home market. We'd like to be big. We'd like to be prolific in this market. But we fish where the fish are. Where there are projects, we'll go after them where we can deliver a quality service to a client.